Ladies and gentlemen, let me begin with a question that may sound uncomfortable but is becoming increasingly relevant in today's global economy. What if the next financial weapon is not a currency, not sanctions, not even technology, but a metal we have underestimated for decades, silver? While headlines remain focused on oil, rare earths, and semiconductors, a quieter, more strategic shift is unfolding beneath the surface. China is not merely accumulating silver, it is positioning silver as a strategic economic lever, and the implications of this move extend far beyond commodity markets. What we are witnessing is not speculation, it is strategy. China is no longer viewing silver as a simple market-traded commodity. It is treating it as a strategic input woven into national economic planning. This shift matters because history shows that nations which control critical resources tend to shape the rules of global trade rather than follow them. The real story is not how much silver China holds today, but why it is quietly ensuring that access to silver remains firmly within its influence tomorrow. That alone should force markets to rethink long-held assumptions about supply security and pricing stability. At the core of this strategy is control rather than speculation. China has steadily expanded domestic silver mining while simultaneously strengthening its grip over refining and processing capacity. Mining alone is not power, processing is. By dominating the midstream of the supply chain, China ensures that even silver sourced globally often passes through Chinese infrastructure before reaching end users. This creates a form of invisible leverage that does not appear in headline reserve figures but becomes extremely powerful during periods of disruption. When supply chains tighten, the gatekeepers, not the miners, dictate outcomes. The hook most analysts overlook is timing. China is accumulating and securing silver before global demand fully reflects the next wave of industrial expansion. Electrification, renewable energy, advanced electronics, and defense technologies are all silver-intensive, yet current market pricing still treats silver as abundant and secondary. By acting early, China positions itself ahead of demand curves that have not yet fully materialized. When demand accelerates, control over supply will translate into pricing, influence, industrial advantage, and geopolitical flexibility. This strategy also aligns with China's broader risk management framework. Reliance on open global markets has proven fragile in an era of sanctions, trade barriers, and financial weaponization. Silver, as a tangible and essential resource, offers insulation from these risks. Securing physical access reduces exposure to external policy shocks while reinforcing domestic manufacturing resilience. In economic terms, this is not hoarding. It is insurance, purchased at a time when premiums remain relatively low. What makes this approach especially effective is its subtlety. There are no dramatic announcements, no aggressive policy declarations. Instead, China allows market mechanisms to do the work. Incremental accumulation, long-term contracts, and strategic investments quietly tighten availability elsewhere. Competitors may not notice the pressure immediately, but over time, higher costs and supply uncertainty begin to surface. By the time the market reacts, the strategic position is already established. Ultimately, this is about shaping the future balance of economic power through foresight rather than force. Silver is becoming a foundation metal for the next industrial era, and China is positioning itself as a central steward of that foundation. The real question for the global economy is not whether this strategy will have consequences, but who will recognize them early enough to respond. Silver occupies a rare position in the global economy, and this is precisely why it offers a form of leverage that few other assets can provide. It is not confined to vaults or balance sheets, it is embedded in factories, power grids, data centers, and defense systems. China's understanding of this dual nature transforms silver from a passive resource into an active economic instrument. The moment silver prices move, the impact is not limited to investors. It ripples through entire industrial ecosystems. That is where influence quietly turns into power. The first layer of this leverage lies in silver's industrial indispensability. Modern economies cannot scale clean energy, advanced electronics, or next-generation transportation without it. Solar panels rely on silver's conductivity, electric vehicles depend on it for power management, and high-precision electronics require it for reliability when a single metal touches so many growth sectors at once. Even small disruptions in supply or price can alter investment decisions and production timelines. This is the hook markets often underestimate. silver is not optional, and substitution is neither easy nor cost-effective. At the same time, silver retains its monetary character. In periods of inflation, currency instability, or financial stress, silver behaves as a store of value accessible to both institutions and the public. This creates a feedback loop. Rising industrial demand tightens supply, while financial uncertainty increases investment demand. When these forces converge, price volatility accelerates. China's position within this dynamic allows it to benefit on both sides of the equation, supporting domestic industry while holding an asset that gains relevance as global confidence in paper systems fluctuates. But the real strategic advantage emerges when these two roles interact. Higher silver prices increase input costs for manufacturers globally, particularly in countries heavily invested in renewable energy and advanced technology. This does not require deliberate market intervention. It occurs naturally through supply-demand mechanics. Meanwhile, China's vertically integrated supply chains and state-supported industries are better positioned to absorb or offset these costs. The result is a subtle shift in competitive balance, where price pressure becomes a structural advantage rather than a constraint. There is also a psychological dimension to this leverage. Markets are accustomed to viewing silver as secondary to gold, a metal that reacts rather than leads. But when silver begins to influence strategic sectors, perceptions change rapidly. Investors reprice risk, industries reassess sourcing strategies, and governments begin to recognize vulnerability. By the time silver is widely acknowledged as a strategic choke point, influence has already been established. What makes this approach particularly effective is that it operates without confrontation. No tariffs, no sanctions, no overt policy moves, just control over a metal that sits at the intersection of money and manufacturing. In an era where economic power is increasingly exercised through supply chains rather than borders, silver's dual role gives China a form of leverage that is both quiet and enduring. Silver's supply dynamics make it fundamentally different from most assets that investors and policymakers are accustomed to tracking. And this difference is where strategic opportunity emerges. Unlike gold, which is largely mined, stored, and recycled back into the market, silver is steadily consumed. Once it enters industrial use, much of it is dispersed into products where recovery is technically complex and economically unattractive. This creates a structural drain on available supply that compounds year after year, often hidden beneath the surface of stable-looking production figures. The critical hook is this: even if global silver mining output remains flat or grows modestly, effective supply can still shrink. Industrial demand does not pause, and recycling cannot keep pace with consumption. Solar panels, electronics, medical equipment, and defense technologies absorb silver in small quantities per unit, but at massive scale. Over time, these small losses accumulate into a meaningful deficit. Markets tend to underestimate this slow erosion, focusing on annual production numbers while ignoring the irreversible nature of consumption. China's strategy aligns precisely with this overlooked reality. By securing silver in advance through domestic production, long-term import agreements, and industrial stockpiling, China positions itself on the favorable side of an asymmetric equation. When supply tightens, those with secured access gain stability, while those dependent on open markets face rising costs and uncertainty. This is not a sudden shock strategy. It is a gradual tightening that becomes visible only when flexibility has already disappeared. The consequences of supply tightness extend far beyond pricing charts. Manufacturers operating on thin margins become increasingly sensitive to input volatility. Long-term planning becomes more difficult, especially for industries tied to energy transition targets and advanced technology deployment. In such an environment, access to consistent silver supply becomes a competitive advantage, not just a procurement issue. China's integrated industrial ecosystem is structured to internalize this advantage, allowing it to shield key sectors from disruptions that affect competitors elsewhere. What makes this situation particularly powerful is that it is driven by physics and economics, not policy declarations. Silver is consumed because modern technology requires it. Recycling is limited because recovery costs exceed value in many powerful applications. These constraints are not easily altered. By recognizing and acting on this reality early, China transforms an overlooked material characteristic into long-term strategic leverage, reshaping how scarcity itself influences global economic balance. So, In an era where financial systems are increasingly used as instruments of pressure, economic resilience has become as valuable as growth itself. China's focus on physical assets, such as silver, reflects a calculated response to a world where access to payment systems, reserve currencies, and capital markets can no longer be taken for granted. Silver offers something that fiat systems cannot: independence from political discretion. It exists outside digital ledgers, outside sanctions frameworks, and outside the immediate reach of monetary authorities, making it a quiet anchor in a volatile financial landscape. The hook many overlook is that de-dollarization is not about abandoning the dollar overnight, it is about reducing vulnerability incrementally. Silver plays a supporting role in this process by reinforcing domestic production rather than replacing currency reserves directly. When a nation can secure the raw materials necessary for energy, technology, and defense internally, it reduces its exposure to external financial shocks. The real power lies not in bypassing the dollar, but in needing it less when conditions tighten. Silver strengthens this resilience through its direct link to industrial self-sufficiency, by ensuring stable access to a metal essential for high-value manufacturing. China protects its growth engines from currency volatility and external funding constraints. Even if global financial conditions deteriorate or capital flows become restricted, domestic industries can continue operating with fewer disruptions. This transforms silver from a commodity input into a strategic stabilizer embedded within the real economy. There is also a balance sheet dimension to the strategy. Physical assets retain intrinsic value regardless of shifts in monetary policy as interest rates fluctuate and currencies compete for credibility. Tangible resources provide a form of insurance that does not depend on trust in any single financial system. For China, holding and controlling silver complements broader reserve diversification efforts, reinforcing confidence during periods of global monetary stress without provoking immediate market reactions. What makes this approach especially effective is its alignment with long-term planning. Financial systems evolve, alliances shift, and policies change, but the industrial requirement for silver remains constant. By anchoring resilience in physical necessity rather than financial promises, China builds a buffer that operates silently in the background. This is not a defensive retreat. It is a structural adaptation to a more fragmented global economy. Perhaps the most compelling aspect is how this strategy alters the risk profile of economic confrontation. When a nation is less dependent on external currencies and supply chains, traditional financial pressure loses effectiveness. Silver, embedded in production rather than stored as symbolic wealth, becomes part of a broader architecture of economic autonomy in a world where financial influence is increasingly contested. Resilience itself becomes a strategic asset, and silver is one of the tools quietly reinforcing it. Modern economic power rarely announces itself through dramatic policy statements or confrontational moves. Instead, it often operates through subtle shifts in market structure that only become visible once their effects are widespread. China's approach to silver exemplifies this new model of influence. Rather than restricting exports, imposing quotas, or issuing explicit directives, China allows normal market behavior to carry strategic weight. This is where quiet market influence becomes more effective than overt confrontation. The hook lies in understanding how markets respond to incremental pressure. Small, consistent increases in demand from a dominant buyer do not trigger alarms. They are absorbed as routine fluctuations. Over time, however, these purchases tighten available supply, especially in a market where production growth is limited and consumption steadily rises. Prices begin to edge higher, inventories thin out, and volatility increases. None of this appears coordinated, yet the cumulative effect reshapes the market environment in a way that favors those who planned ahead. This strategy is particularly powerful because it leverages existing market mechanics rather than challenging them. No trade rules are violated, no international agreements are broken. Supply contracts, refining capacity, and industrial demand function exactly as designed, but when a single economy integrates silver across mining, processing, manufacturing, and long-term procurement, it becomes a gravitational center within that system. Other participants must adapt to the conditions it helps create, often without realizing the source of the pressure. For global industries, the consequences emerge gradually. Manufacturers face higher and less predictable input costs, complicating long-term investment decisions. Energy transition projects, which rely heavily on silver-intensive Technologies encounter budgetary stress as materials become more expensive. Smaller economies and firms, lacking scale or secured supply, feel these effects first. The market does the signaling, but the underlying cause remains largely unspoken. Another hook is perception. Because the process unfolds quietly, it is often misread as cyclical or speculative rather than structural. Policymakers may attribute rising prices to temporary demand surges or investor sentiment, delaying strategic responses. By the time supply tightness is recognized as persistent, alternative sourcing options are limited and bargaining power has shifted. Influence, at that point, is already embedded in the system. What makes this form of economic power especially resilient is its deniability. There is no single action to reverse, no policy lever to counter. Market participants are simply responding rationally to new conditions. In this environment, pressure is exerted without confrontation, and adaptation replaces resistance. By allowing silver markets to evolve naturally under sustained demand and integration, China demonstrates how influence in the modern economy can be exercised most effectively when it appears to be doing nothing at all. So the global economy is entering a phase where long-term positioning matters more than short-term cycles. And this is where China's approach to silver reveals its broader strategic intent. Industrial leadership in the coming decades will be defined not only by innovation and capital, but by secure access to foundational materials. Silver sits at the core of electrification, digital infrastructure, advanced manufacturing, and defense technologies. By aligning control of this metal with its industrial ambitions, China is embedding itself deeper into the architecture of future growth. The hook many fail to recognize is that industrial dominance is cumulative. Each new factory, energy project, or technology platform increases dependence on stable material inputs. When a nation can guarantee supply while others rely on volatile markets, it gains a planning advantage that compounds over time. China's long-term contracts, integrated supply chains, and state-backed industrial policy reduce uncertainty for domestic producers, allowing them to scale faster and invest with greater confidence. This creates momentum that competitors struggle to match. Geopolitically, this positioning shifts leverage without triggering immediate resistance. Countries pursuing aggressive climate targets, digital expansion, and military modernization become increasingly sensitive to silver availability and pricing. As these dependencies deepen, strategic flexibility narrows. Decisions once driven purely by policy or alliances begin to reflect material constraints. Influence emerges not through coercion, but through necessity. As access to inputs shapes what is economically feasible, there is also a signaling effect embedded in this strategy. Control over critical materials communicates seriousness about long-term commitment to industrial leadership. Investors, partners, and governments take note when supply chains demonstrate resilience during periods of stress. This reinforces China's role as a central manufacturing hub while encouraging further capital inflows and technology partnerships. Stability attracts scale, and scale reinforces stability. Another overlooked dimension is intergenerational planning. Short political cycles in many economies favor immediate returns, often at the expense of resource security. China's approach reflects a different time horizon, one where securing tomorrow's materials is as important as today's output. Silver, with its rising strategic importance and limited substitution options, fits neatly into this framework. Acting early converts foresight into advantage. As global growth becomes increasingly resource-constrained, competition will intensify not just over markets, but over inputs. In that environment, those who planned ahead will not need to negotiate from weakness. They will set conditions. By embedding silver into its long-term industrial and geopolitical strategy, China is not merely responding to change. It is shaping the terrain on which future economic competition will be fought. So let me leave you with this final thought. The most effective weapons in modern economics are often invisible until they are unavoidable. Silver is no longer just a metal traded on exchanges. It is becoming a strategic asset embedded in power, policy, and production. China is not guessing, it is planning. And those who fail to recognize this shift may find themselves reacting rather than leading. The question is not whether silver will matter. The question is who controls it, who prices it, and who depends on it. In that equation, China is moving early, quietly, and decisively. History teaches us that economic power rarely announces itself. It reveals itself when it is already too late to ignore. Thank you.